Looking back now with the benefit of hindsight, we can see that the 23rd of March 2020 was the lowest point in a stock market crash caused by the coronavirus and by the lockdowns implemented worldwide. But was it the bottom or just the lowest it has been so far? Is there more pain to come?
People expect a second crash, and in our last video we did say we expected a small correction, but our economic worries already priced in to prevent a second major crash. As time has passed, we now know better with what we're dealing with. It's become more apparent, with extensions to furlough schemes and the slow snail-paced reopening of the economy, that this isn't going to be a lightning-fast recovery.
But it looks like we are in a recovery nonetheless. Those waiting and pinning their investment hopes on another major crash of 20, 30 or 40% are looking more and more likely to be disappointed. They would have missed the bottom and then failed to invest during the relatively low priced period of the recovery.
Will the history books look at March 2020 as the bottom of the crash? Or is there more chaos to come? Let's check it out. Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe.
The easiest way to begin investing is through a stock market zero fee trading app like Freetrade. They'll give you a free share worth up to £200 when you open a new account through our link at Unshackled.com. Now let's get into the video.
Why have people been expecting a second crash? Everyone knows that there'll be a second crash. Here's a list of other things that everyone knew would happen. Remain would win. Bitcoin will keep going up. Trump as president, yeah right. Hung parliament in December 2019 UK election. Oh yeah, and 2020 would be a normal year.
Time and again, what seems like the most obvious course of events doesn't pan out that way. People are so sure there will be a second crash because it seems obvious that the stock market shouldn't be climbing like they are doing now, when the economy is falling apart around us.
We think there probably will be a correction of around 10%, and soon. The US stock market index, the S&P 500, is only down 10% from its pre-corona highs, and the Nasdaq 100 is only down 3%. So a correction, yes, but a full-on crash of 20 to 40%? Back to the levels seen in March or below? Maybe, but unlike most investors, we're not taking it for granted that there will be one.
Already priced in. The March 2020 crash followed earth-shattering revelations about a new disease sweeping the world. The markets acted accordingly and plummeted.
Since then, coronavirus has been analysed from all angles. It's not as deadly as first feared, disproportionately affecting the elderly and the ill, and mostly sparing the children. Health systems the world over looked like they would collapse in the early days, but then they didn't. The NHS in the UK is on top of the crisis now, having done far better at scaling up than was expected back in March.
And this information is already out there in the markets, and in theory should already be factored into the price of stocks, as is an expectation of further bad economic news still to come. It's worth remembering that the economy is not the same as the stock market. The stock market should be anticipating the economy and pricing it in accordingly. Regarding ending the lockdown, there is no expectation in the markets of a vaccine anytime soon. Talk of 18 months plus has been widely documented. The markets are prepared for this to be a long drag. They are expecting a rough ride and have priced this in. Positive news, however, could send prices upwards even more. Those investors staying the course can laugh at the constant doom mongers.
How common are double dip recessions anyway? Beginning in the summer of 1997, a number of Southeast Asian countries experienced a financial crisis that would wreak havoc on their currencies and the broader emerging markets in general. The MSCI Emerging Markets Index proceeded to get chopped in half over the next year or so, dropping 56% from August 1997 to August 1998. But that was the end of it. The market then proceeded to climb again until 9/11.
In 2001, there was a market crash following the 9/11 attacks. The stock market recovered for a year, and then there was a second crash. But this was largely due to the bubble of the past decade popping, not necessarily to do with 9/11.
The 2008 recession did see a double dip crash. The first crash happened in October 2008, and then another one happened in March 2009, 5 months later. The FTSE 100 crashed from its recovered position of around 4,500 to around 3,500, a 22% fall. That's one time out of these 3 recent stock market downturns, the most recent one in fact, which may be the most in people's minds, and what is driving expectations this time around.
2009 versus 2020. The 2009 crash was caused by the financial system gradually falling apart, the full extent of the mess finally being uncovered just prior to the second dip of the crash. There's a lot of potential for something similar to happen now, except this time around, the problems are not with the banking sector. Their banks are actually helping us this time around. This time, it was due to locking down what was a relatively healthy economy.
We agree that it is totally feasible that new information could emerge which spooks the markets, causing a 2009 style double dip crash. But is it worth staking our portfolios on?
50-50 odds. There probably will be a correction, and soon, but there's no guarantee that markets will fall to where they were in March, let alone any further. Economists are talking of a 10% correction. The S&P 500 has climbed 32% already since the March bottom, and the FTSE 100 by 22%. For perspective, the second dip of the 2009 crash caused the FTSE to fall by 22%, equal to what it's already climbed by this time around. We don't know if there's going to be a full-on double dip crash or not. The only thing predictable about the stock market in the short and medium term is its unpredictability. We put it at 50-50. That's not enough to justify holding back all of our cash now in the hopes of a second crash.
What if there's no second crash? We will be kicking ourselves later if we don't stay invested now while prices are acceptable and it turns out that all this talk of a double dip was nonsense. If it turns out that potential future economic woe was already priced in. What if the world economy does just slowly crawl out of lockdown and gradually get better? To us, that seems just as likely as not.
We think investors are wrong to be holding back all of their cash now, thinking they know better than the market. If markets don't crash again, they'll have missed out on buying into the recession at low prices, gambling on there being a perfect buying event.
What would it take for there to be a bigger bottom? No, not more lockdown takeaways. Here's 3 things that we think could trigger a proper double dip crash. Number 1. Virus mutation. If the virus were to evolve into something worse than what we are able to deal with, that would shatter the markets. Supply chains would be out of action for the foreseeable future.
Number 2, economic news. If the magic money tree borrowing of our government and others around the world ends up causing a sovereign debt crisis, which it surely will if they don't stop soon, cash would stop flowing around the world and economies would shut down completely. That would not be great for the stock market.
Number 3, the public don't comply. When the government feel comfortable to restart the economy, they will be relying on everyone to get back to work and start going out again. We can imagine that a good chunk of the population will refuse to do so, having been scared rigid by coronavirus news over the last few months.
There's a saying, you can lead a horse to water, but you can't make it drink. Likewise, the government could open the economy, but they can't make people leave their homes if they don't want to. Self-imposed financial ruin has not been factored into stock prices as far as we can tell, but people are scared. It could happen.
Investing during uncertainty, getting it right. We advocate the twin approach of drip feed and war chest strategy for investing in a recession. Is a best of both worlds approach. Maybe you could invest half of what you are able to each month and hold the other half back in a war chest, only to be used in cases of a market correction or crash.
That way, you are crucially investing during the recession when prices are historically low and can also take advantage of big one-off events. If no event does happen and the world looks rosy again, you could slowly release your war chest into the markets.
Question of the day, what are the odds of a double dip crash of say 20% or more? Or do you see a smaller correction of 10% on the horizon? Tell us in the comments section.
Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.